All right, once again, welcome everybody. My name is Noel Booker, and this is Business Credit Builder. And today we're going to be talking about what lenders look at to approve you for financing. Okay, and this is important to know because it's good when you apply. There are a lot of things going on when you apply for a loan or even a basic account. There are a lot of things going on behind the scenes you might not know about, and it's good to understand the process. At Business Credit Builder, what we do is help entrepreneurs build their business credit and access funding. Okay, so let's get going. Here goes my contact information. My name is Noel A. Booker Sr. The name of the business is businesscreditbuilder.us, LLC. Got my contact information posted up there, and there are 3 buttons at the bottom. The green button is how you can get a free guide on how to build business credit. Just go to businesscreditbuilder.us/free guide and get that free guide. The blue button is how you can get a free business credit consultation. That's when you want to talk to us about the services that we provide in helping you build business credit and accessing funding and websites and accounting. Okay. And the red button is for when you think that you qualify for funding now. That's where you go. businesscreditbuilder.us/get funding. All right. Okay. Business financing. It can be a challenge, particularly for startup companies. Lenders tend to be cautious. They want to be sure you'll pay them back. Well, they can't be sure, right? So they're taking risks, strategic risk. Okay. There are several options when it comes to business lending. Okay. There are several options, and these include traditional lenders, usually the banks, online lenders, micro lenders, and the SBA. Okay. Now, the SBA is actually not a lender, right? They guarantee these loans that are generated from the bank. Okay. What do loan applicants need to supply? Okay. So it's good to have this stuff already ready when you're getting ready to apply, right? So you plan. Lenders generally want to see that you have enough assets, sufficient financial reserves, and enough personal collateral to ride out business fluctuations. How do loan applicants demonstrate these things? Well, borrowers need to show a solid cash flow, sufficient to repay the loan. They need to show a track record of profitability, and they have to demonstrate success in a similar business endeavor. Essentially, they have to prove their credit worthiness. Okay? And this isn't easy when you're just starting out, right? Okay. How do borrowers prove their credit worthiness? For startup entrepreneurs in particular, they will need to demonstrate by using their means that they are credit-worthy business owners. One way is to prove they owned or managed a profitable business in a different industry. This means bringing in a resume, maybe financials from an earlier venture. They may be able to show this if they can supplement their own experience with that of someone who also has success in the field. This means bringing in a partner or maybe an angel investor as a mentor. Okay, preparing to meet with a lender. The borrower should have the following items: a sound business plan, any financial information they can provide on their business, information on their personal credit, often also some means of securing the loan. What goes into a sound traditional business plan? Industries vary, but traditional business plans all have similar components. These are an executive summary, description of the company, a market analysis, okay? Business plans also include data on the company's organization and management, a description of the service or product line, marketing and sales data. Startups won't have much in the way of sales data, but they should have a handle on how they're going to market their wares. Business plans also include the company's actual funding request, financial projections, and an appendix, which includes all supporting documentation. Did my camera go down? Where's the stuff at? Hold on one sec. Where's the thing at? Okay, here we go. Okay. Okay, so startup business plans, all right? These are usually shorter than traditional plans. They include information on key partnerships, activities, and resources, the value proposition, customer relationships and segments, okay? They also include communications channels, cost structure, and revenue streams, okay? Parts of a traditional business plan: an executive summary, a brief overview of the company, product, executive team, and future plans for growth, okay? Company description: get into detail about your company's niche and the problems it solves, right? So you have to present what the problem is and how your company is going to solve that problem. Market analysis: how can you do better than your competition? Company organization and management: what's your business entity and who does what? Service or product line: not only what you sell, but also future plans or even patents. Marketing and sales data: what are your strategies to attract and retain customers? The company's, okay, parts of a traditional business plan, okay? Parts of a traditional business plan, okay? The company's actual funding request. Itemize and clearly show how you are looking to spend the funds. Financial projections include income statements and the like if the company is already established. If not, this is a place to list potential collateral. An appendix: here's where to add licenses, permits, and patents, and the like. Parts of a business of a startup business plan. Startup business plan, okay? Key partnerships with suppliers and manufacturers will you work with? Which suppliers and manufacturers will you work with? Key activities. How will your company gain a competitive advantage? Key resources. Which resources will you leverage to give your customers value? This can include personnel, intellectual property, capital. Okay, as we continue with parts of a startup business plan. Value proposition. Which unique value will your product or service bring to the market? Customer relations, customer relationships. What will the customer experience be like? In person, online, something else? Customer segments. Who will your business serve? Do you have a good handle on what your ideal customer, aka the buyer persona, is really like? Let me see, is there a question in there? Oh, that's Miss Stills. Hello, Miss Stills. Okay, let's move forward. Parts of a startup business plan. Communication channels. How will you speak with your customers? How will you optimize communications in the future? Cost structure. Will you be trying to maximize value or reduce costs? Regardless of strategy, how much is that going to cost? Revenue streams. How will your venture actually make money? Direct sales, membership, subscriptions, selling, ad space, something else, whatever it is. How are you going to get revenue? Financial information on the business. Apart from the business plan and its contents, you will need a P&L. That's a profit and loss statement, okay? A P&L is, according to Investopedia, a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time, usually a fiscal quarter year. These records provide information about a company's ability or lack thereof to generate profit by increasing revenue, reducing costs, or both. The P&L statement is also referred to as the statement of profit and loss. The income statement, statement of operations, statement of financial results, and income and expense statement. That's the basic one. And from using this for your business, you will be able to analyze and strategize for your business, all right? Okay, the P&L, AKA the income statement, one of 3 quarterly and annual statements a company makes as its financial health. The other 2 are the cash flow statement and the balance sheet. The balance sheet is more used than the cash flow, right? So some people have the cash flow and the income statement, not necessarily the cash flow statement. But when your business is growing, having that cash flow statement is very important as well. There are numerous blank P&L forms that are online to help you. Okay, what does the P&L show? The idea is to show changes in accounts. This is over a specific time frame. And that way, it's similar to your cash flow statement. This is not like a balance sheet, which is more of a snapshot. A P&L will give you a handle on the money your business has. You know how much capital is coming in and going out. It's good for more than just yet another piece of paper to give to a lender. Yeah, it's more than just a piece of paper, right? Because you got to strategize this. This is going to help you grow your business. It's going to seeing what your revenues are over time and your expenses can help you evaluate it. Say, look at expenses, say, well, this expense is going up. Well, if I reduce that expense, my profit's going to go up. If I lower this revenue, then my profit's going to go down, right? And you're able to analyze your data. Monthly and annual revenues. Online lenders in particular want this data. It shows not only what your company makes, but also any trends or even seasonalities. Bank balances. Online and offline lenders want this data. It helps to show not only trends, but also responsible money management. It's also another way of showing seasonality. The power of knowing your numbers. The power of knowing your numbers is vital to running any profitable business. You can make any necessary adjustments to show a profit. Numbers do not lie. They tell everything about the health of a business, okay? Knowing your numbers means that you have a huge advantage over business owners who do not. Your profit and loss statement tells a story of your unique business. Understanding the story behind your numbers can be an extremely important factor in achieving success. Personal credit information. Lenders will also want to see your FICO score. This is particularly the case for sole proprietorships and startup companies. They want to know if you're experienced in paying back loans or if you default on your obligations. Time in business. For online lenders in particular, time in business matters. Of course, a startup has no time in business, but other ventures do, because so many businesses fail in their first year. Creditors want to know this. Means of securing the loan. Lenders are often looking for a means of securing the loan. This protects them in case you default on your obligations. Fortunately, collateral and other means of securing loans can be done creatively, okay? Collateral-based loans. Use your assets as collateral. Rates are often 5% or less. Your personal credit rating will not matter in these situations, right? Some of the types of collateral you can use. You can use investments like your 401k, stocks, existing inventory, accounts receivable. That's if you have clients that owe you, right? Or if you're a business that can batch and sell your invoices. Or ask a friend or family member with these kinds of assets. They may let you leverage their asset in exchange for a percentage of your business. Essentially, they would be acting like an angel investor. It's a bonus if they can mentor you in business. 401k financing. Use existing 401k or IRA as collateral for your business financing. Pay no tax penalties. You still earn interest on your 401k. Low rates often has less than 5%. Okay. Close and fund in less than 3 weeks for these right here. Okay. Okay. Securities-based financing. Use your existing stocks as leverage to get business financing. Borrow as much as 90% of the value of your stocks. You keep earning interest on the stocks pledged as collateral. Closing and funding takes less than 3 weeks. Securities-based financing, 70 to 90% loan value. Rates are like mortgage rates. 5% is common, but you only pay interest on what you borrow. This is a working capital line of credit. Okay. Challenge personal credit. Oh, yeah. So these challenge personal credit is okay because you're putting up the securities as collateral, right? Inventory financing. Use your existing inventory as collateral for business financing. You will need inventory valued at $300,000 or more. You can get approved for a line of credit for 50% of the inventory value. Rates are usually 5 to 15%, depending on the type of inventory. Funding within 3 weeks or less. Okay. Minimum inventory loan amount of $150,000. General loan to value cost is 50%. So inventory value needs to be $300,000 or more. It can't be lumped together inventory like office equipment. Okay. Accounts receivable financing. Using your outstanding accounts receivable for financing. Get as much as 80% of your receivables advanced ongoing in less than 24 hours. Remainder of the accounts receivable is released once the invoice is paid in full. Closing takes 2 weeks or less. Okay. Okay. Accounts receivable financing. Factor rates are as low as 1.33%. It is a credit line with rates as less than 1% with no consumer credit required. Receivables should be with the government or a credible business. If you also have purchase orders, you can get financing to have those filled, right? Purchase orders, or if you have government contracts, you can get a loan, okay? You won't need to use your cash flow to do so. Okay. Get forwarded up to 80% of your receivables. You have to be in business for 1 year. These must be receivables from another business. Rates of 1.25% to 1.5% to 5%. Other collateral options. Other collateral options include your company's equipment. You can also use invoice factoring. Invoice factoring is not quite a loan. Instead, you essentially sell your outstanding invoices to a factoring company, and they collect directly from your customers. Personal guarantees. Another option is the personal guarantee. It's exactly what it sounds like. Your personal assets are at stake, but sometimes, particularly for startups, you'll have to give one. Microloans. Microloans are another option. You can't get a microloan from a regular lender. Instead, you get a microloan from a micro lender. Try the Association for Enterprise Opportunity to find a local micro lender. Let me say that again. Try the Association for Enterprise Opportunity to find a local micro lender. Okay, check out the website, microenterpriseworks.org. Okay, right there. You got it? All right. SBA. SBA loans are another option. You usually need to show some time in business for SBA loans. The most popular SBA loan for working capital is the 7A. Approvals for up to $750,000. Rates are usually 2 to 4% above prime rate. All owners with more than 20% ownership must provide a personal guarantee. Good consumer credit is required. So the SBA loans, they have a lot of requirements, right? So when the bank says no, Business Credit Builder can help. Okay, here's a recap for what lenders look at to approve you for financing. Lenders want to be sure a company can pay its bill, its obligations. They want to know your business is a going concern. They want to see if it is succeeding or if it should be. Borrowers need to prove their credit worthiness. Documentation is crucial. Virtually every lender wants to see a business plan. Business plans can be traditional or for startups, and these have different sections. Lenders also want to see a P&L, profit and loss statement. They usually also want some sort of collateral or personal guarantee. And in closing, let me just say this one thing, right? About the 3 C's. Is the 3 C's of funding, right? Credit, cash flow, collateral. Lenders are gonna look at these 3 C's, right? So if you have all 3 of these 3 C's, then you could possibly qualify for an SBA loan. If you have 2 of these 3 C's, then you can possibly qualify for a term loan. And if you have 1 of the 3 C's, depending on which one it is, then you can qualify for some money. And when you don't have any of these 3 C's, that's when you start with business credit. And as you build business credit, you get access to more and more money. And the thing is, you have to strategize this. Everybody has a different situation. So you have to strategize. What is it that I need to buy? And then how am I going to finance it? It may not be getting a lump sum of money and just taking care of everything. That normally doesn't happen, right? So you have to piece things together. Finance this way, finance that another way. You have to piece things together and strategize, okay? There's a bunch of information on my blog, ladies and gentlemen. My blog and the podcast is called Business Credit is Real, all right? The podcast is on Spotify, and we got all these other social media outlets, so check it out. Make sure you get your free guide on how to build business credit at businesscreditbuilder.us/free guide. And we have all these ebooks, right? So you can go check out the ebooks at /ebooks. Check it out, right? And if you want to talk to us about any of the services that we provide that can help you build your business credit, access funding, accounting, websites, and more, contact us. So schedule your free business credit consultation. Does anybody have any questions at this time? No questions? Danielle says, good stuff. Okay, well, I hope I didn't waste y'all's time and my time, right? So it's basically good stuff here. It's also good to know what the lenders are thinking and how you should be organizing your stuff, how they're really looking at you, right? Okay. Microloans, we want to go back over to microloans. All right, let's go back. Let's go to microloans. All right, here we go. Microloans. The basic deal with the microloans is you can't get one from a regular lender, right? You have to get it from a micro lender. And this is the place where you get it. Get it from the Association of Enterprise Opportunity. So you go to this website and you'll find out the micro lenders that are in your area. Is that the information that you needed, Danielle? All right, great. Who else had something in here? Sherry says, any recommendations on an invoice company? An invoice company. What do you mean, an invoice company? You can open up your mic if you get a microphone.
Hello, can you hear me?
Excuse me?
Oh, just wanted to make sure you can hear me.
Oh, yeah, I hear you. Go ahead.
Awesome. Yeah, you had up there earlier, I think it was an invoice, it might have been factoring company. If you had any recommendations on who could possibly service that in the area.
Oh, there's a list of them. I don't have one off the top of my head, but you know, when my clients come in, then we figure out what your company situation and which lenders is going to match up for you, right? So I don't have any off the top of my head. I have to go research, match them up with your particular company, and you know, see which is a good match for you, right?
Okay, great.
Yeah.
Thank you.
Any other questions? Any questions on business credit? Does anybody have any business credit questions? No? Oh, we got something else down here. Let's see. What's the pros and cons of what?
Hi, it's Danielle. So when you talk about the micro loans, I'm still kind of confused of what's the difference of going to them versus you saying you can't get it from a regular lender. What exactly is a micro loan is what I'm kind of confused about.
Well, micro loans are easier to qualify for, right?
Less documentation.
Yeah, less documentation. They offer less money, right? So they're good for smaller businesses. Every situation is different, right? So you have to just find the micro lenders in your area and see what their requirements are, right? They're usually not as stringent as the regular banks. Okay. Square. You use Square to accept credit cards. Is that what you mean? Or Square to get lending based off your sales? Miss Stills. Oh, right. Square does that, right. Square does that. PayPal does that too, you know, based on, you know, your sales in the past, right? Okay. Okay. Ms. Stills has a question. How can you start business credit? Okay. And Ms. Stills credit cards and create my invoices. Okay. How can you start business credit? Okay, first, in order to build your business credit, you need your business set up credibly in the eyes of the lender, which is really simple, but it's the most important piece, right? Which is your name, a business telephone number set up in the right way, your address, your business address. There's only 3 options for your business address. You got to have an EIN number, you have a bank account, you have a website, and you have a DUNS number. Those are the easiest things, right? But they're the most important things that make sure that it's exactly correct. And then you start building up your business credit by creating a business credit profile. Once you got your business set up credibly in the eyes of the lender, then you will go to net 30 accounts, and these net 30 accounts are companies that's going to give you credit when you have no credit and they have to report to the business credit reporting agencies. It's hard to find these starter vendors, okay? But these starter vendors is how you start your building up your business credit. I got many webinars on my YouTube channel that deal with this, okay? So you can get information on that and the detailed stuff, all right? And the whole process of building up business credit, okay? So I hope that answered your question, Ms. Stills. And yes, I have those done. Yes, what are some net 30s? Off the top of my head, there's Maverick Office Supplies, there's Granger, Barnett, Uline, right? But check out my webinars. Now, these starter vendors, I'm gonna let you know that these starter vendors, they change their guidelines regularly, okay? So the list I have now is not the same list I had 6 months ago. So they change their requirements regularly, all right? Just so you know. And my staff, we keep up to date on this list, right? The starter vendors. See, we build business credit in 4 tiers of vendors, right? So each tier of vendors will give you about 15 vendors and say, pick 3 of these. Then you'll pick 3 of them, you'll make a purchase, you'll make a payment, then we'll tell you to pull your credit reports. Then we'll help you read the credit reports because they're not that easy to read. And then the credit reports will tell us when it's time to go to the next tier of vendors. And each tier of vendors that we have a staff that just stays up on them all the time to make sure they still are valid vendors for each tier that we provide our clients, right? So I hope I answered that question. And you can, oh yeah, you can find the YouTube channel by going to the website, and there's a YouTube button, right? So just go to businesscreditbuilder.us and check it out, right? Oops, I messed that up. Anyway, yeah, okay, yeah. So yeah, businesscreditbuilder.us. Click the YouTube button. You can also Google me. My name is Noel A. Booker Sr. And that's it. Anybody got any more questions before we get out of here? It's Wednesday night. Ooh, snap, I'm going to Chicago this weekend. All right, any more questions? Okay, Danielle wants to go over the 3 C's again. The 3 C's of lending. And this is very important to understand that when you go to a lender and you ask for a loan or even an account, they're looking at your company and they're trying to determine how you can qualify. And they're going to look at your 3 C's. Your 3 C's would be your credit, business credit, and personal credit, your cash flow, how much cash your business is how much cash is traveling through your business on a monthly basis, right? And your collateral. The best collateral is equity in your home, right? That's the best collateral, equity in your home. And with that, you get a business loan, okay? If you only got credit, I got some stuff that's good for startups. If you got good personal credit, right? You can schedule a call with me by going to the website and click the button that says free consultation, free business credit consultation or something like that. Okay. Yeah. And we'll talk about your particular situation and what you may qualify for, what some strategies might be, right? Because some people's situations, we need to strategize and figure out what the best option is. Because sometimes it's not always clear, because if you don't have them 3 C's, Or even if you got one of the 3 C's, we need to figure out a best way to approach the situation for your particular situation. Everybody's situation is different, right? Okay, ladies and gentlemen, I think we're running out of time right about now. Any last questions, anything? What's up? And I do these webinars about once a week. And it's the best time to, when I talk about a topic, to ask questions and stuff like that. On the webinars, on the YouTube thing, you can't ask questions, right? Even though I answer questions from the people that's present, but check that out. All right, everybody. Just like Miss Steele says, thank you and good night, everyone. All right, good night. Take care, everybody. We out of here.